Imagine for a second, you are running a business.
Yeah.
And you have one specific asset, like a single product that is bringing in more revenue than entire rival companies combined.
Yeah, a true cash cow.
Exactly.
Right.
And for nearly 2 decades, this product has been the undisputed heavyweight champion of your balance sheet.
Right.
But with absolute mathematical certainty that on a specific date, the legal monopoly you hold on this product is going to expire.
The walls just come down.
Yeah, the protective walls come down, dozens of competitors flood the market with cheaper knockoffs, and your golden goose is, well, it's going to be slaughtered. How do you even prepare for that?
Well, historically speaking, the pharmaceutical industry has a pretty terrible track record with this exact scenario. I mean, usually panic sets in.
Right, they just scramble.
Exactly. Management teams start looking for these desperate, overpriced acquisitions to plug the revenue hole, or, they simply accept that their company is going to slowly shrink into irrelevance.
It's a slow decline.
Yeah. The industry actually has a rather grim term for this. It's called the patent cliff. You're walking along a plateau of massive cash flow, and then suddenly you just step off the edge.
Step right into thin air. Well, today we are taking a deep dive into a company that just proved gravity doesn't always apply.
They certainly did.
We're looking at AbbVie, trading under the ticker ABBV, and unpacking their Q2 2026 earnings report. Now, if you follow the markets, AbbVie has been staring down the steepest patent cliff in the history of modern medicine.
Oh, without a doubt.
So our mission today is to strip away the corporate fluff from this earnings call, translate the heavy Wall Street and, frankly, the dense medical jargon, and hand you the data-forward, highly actionable takeaways.
Because there's a lot of noise out there.
Right. We want to understand how a pharmaceutical giant not only survives the loss of the best-selling drug in the world, but somehow manages to build an entirely new mountain of revenue in the process.
And, the broader context here is critical for you to grasp just how unusual this quarter's results really are.
Give us that context.
Well, for years, the dominant narrative surrounding AbbVie was entirely defined by one word, and that word was Humira.
Ah, yes. The blockbuster.
Right. This was their blockbuster rheumatoid arthritis drug. At its peak, it was a cash cow of epic proportions. We are talking about generating north of $20 billion in a single year.
Just an astronomical number for one drug.
Exactly. So Wall Street looked at that massive dependency and concluded AbbVie was a one-trick pony. The prevailing theory was that once the Humira patents expired and competitors swarmed in, the underlying business would inevitably collapse.
Well, let's put that narrative to the ultimate test by jumping straight into the Q2 scorecard. I want to hit you with the rapid-fire top-line data, because the numbers they just reported suggest the old bear thesis is entirely dead.
Completely dead.
So for the second quarter of 2026, AbbVie posted net revenues of nearly $17 billion. That translates to a 10.2% growth year over year, and it beat Wall Street's consensus expectations by roughly $300 million.
Yeah, and a $300 million beat is substantial, sure, but I really want to emphasize the percentage growth here.
10%.
Right. Achieving 10.2% top-line growth when your base is $17 billion for a single quarter. That requires incredible operational velocity.
It's huge.
I mean, we're not talking about a nimble tech startup scaling its first piece of software here. This is a mature, massive healthcare conglomerate battling severe structural headwinds.
So growing double digits is almost unheard of.
Exactly. To grow double digits in that environment implies their replacement products are scaling much faster than anyone modeled.
Okay, so moving down the income statement to the bottom line, their adjusted earnings per share, or EPS, came in at $3.65.
Which is a very solid number.
It is. And that figure actually topped their own internal guidance midpoint by 6 cents. So they're pulling in significantly more cash than the street expected, and they're converting more of it into actual profit for shareholders.
Right. And to understand the mechanics of that profitability, we really need to look at the margins. Their adjusted gross margin is sitting at 84.7%.
Okay, I have to stop you there because I always find pharmaceutical margins fascinating. They sound almost fake to anyone outside the industry.
They really do sound like a typo.
Right. I mean, if you own a retail clothing brand or you manufacture automotive parts, you are throwing a massive celebration if you manage to hit a 40% gross margin. So 84.7% sounds absurd.
It does, but you have to look at what that 84.7% actually represents in the context of biologics and chemical engineering.
Break that down for us.
So gross margin measures the revenue left over after subtracting the direct physical costs of making the product. In pharma, you are not really pricing the physical chemicals in the pill or the saline in the syringe.
So those materials are pretty cheap, right?
Incredibly cheap. That high margin reflects the fact that you are monetizing intellectual property. When a patient buys a drug, they are effectively paying for the 2 decades of failed experiments,
Oh, wow.
They're paying for the sprawling clinical trials involving thousands of patients and the massive R&D infrastructure that made that one successful molecule possible. The physical manufacturing cost is just a fraction of the value.
That makes a lot of sense. And digging deeper into their operational efficiency, their adjusted operating margin is sitting at 48.3%.
Also a massive number.
Right. And this metric takes that gross profit and subtracts all the marketing, the massive armies of sales representatives, and the administrative overhead. Keeping nearly half of every dollar as operating profit is staggering.
The sheer efficiency is impressive, definitely. But we should address a specific quirk in that $3.65 EPS figure.
The 17-cent hit, right?
Exactly. The earnings were actually weighed down this quarter. They absorbed a 17-cent hit from a line item called acquired IPR&D expense.
Yeah, notice that buried in the accounting tables.
Yeah.
And I know terms like IPR&D trip up a lot of retail investors. In-process research and development, walk us through what that actually means when an investor is trying to parse an earnings report. Why does it drag down the profit?
Well, under standard accounting rules, if AbbVie were to buy a physical asset, say a massive new manufacturing facility in Ireland, they wouldn't take the entire cost of that building as a penalty against this quarter's earnings.
Right, they'd spread it out.
Exactly. They would capitalize it and depreciate the cost over 30 years. However, the rules are very different for scientific assets.
Oh, really?
Yeah. During this quarter, AbbVie spent cash to acquire early-stage science from other companies. They are buying intellectual property or molecules that have not yet received FDA approval.
So it's a bit of a gamble.
It is a gamble. And because there is a high risk that these early-stage drugs might fail in clinical trials and never actually reach the market, accounting standards require the company to expense that entire purchase price immediately.
Wow, all at once.
All at once. So they take the full financial hit right now on the income statement rather than spreading it out over decades.
So it acts as an artificial anchor on the current quarter's EPS.
Precisely. Management views this as a short-term accounting penalty in exchange for a long-term strategic advantage. They are actively deploying the massive cash flow generated by their current drugs to buy the seeds for future growth.
Got it.
So if you were to hypothetically add that 17 cents back into the equation, the underlying operational outperformance of the business becomes even more pronounced.
Okay, I need to push back a little here, though. We are looking at a $300 million revenue beat, pristine 48% operating margins, and we are casually waving away a 17-cent earnings hit as just a strategic investment.
Sure, it sounds a bit convenient.
Right. How often do pharmaceutical companies use IPR&D write-offs to obscure messy quarters? Like, is this just accounting magic, moving numbers around on a spreadsheet to keep Wall Street happy? Or is this actual boots-on-the-ground operational muscle driving the core business?
That is the essential question to ask whenever you see adjusted earnings. But the data here strongly points to actual operational muscle.
Okay, prove it.
The proof isn't in the accounting adjustments at all. It is in the product-level revenue data. What is happening beneath the surface of these headline numbers is arguably the most successful portfolio transition the pharmaceutical industry has ever witnessed.
That's a bold claim.
We have to dive into the specific drugs to see how they are actually pulling this off.
Let's do it. Let's address the elephant in the room then, the Humira cliff. We mentioned earlier that Humira was their legacy blockbuster for immunology, used to treat severe conditions like rheumatoid arthritis and plaque psoriasis.
Right.
In the second quarter, global sales for Humira plummeted by 36.1%, down to $756 million.
Ouch. Yeah, a 36% drop in a single quarter is a brutal bleed. And this is exactly the scenario the market had been dreading for a decade. The decline is entirely due to biosimilar competition.
Now, we should clarify what a biosimilar actually is, because it is very different from a standard generic drug, right? I mean, when the patent for something like Tylenol expires, any manufacturer can easily copy the chemical formula.
The distinction is vital. A traditional pharmaceutical like aspirin or a statin is a small molecule drug.
Okay.
It is a very simple chemical compound that you can perfectly replicate in a lab, which is why generics are so incredibly cheap to produce.
Right.
Humira, however, is a biologic. It is a large, incredibly complex protein that is literally grown inside living cell cultures.
Wow. Okay. So it's alive.
Essentially, yeah.
Yeah.
You cannot create an exact generic copy of a biologic. The manufacturing process is too organic and variable. Instead, competitors create a biosimilar.
Which is what exactly?
It's a drug that is highly similar in structure and function, but not an identical twin.
Okay, so because it is so much harder to manufacture a biosimilar, the price erosion doesn't happen overnight like it does with generic pills.
Right. The erosion is slower, but it is still devastating to the incumbent. When the Humira patent expired, competitors were finally allowed to introduce these biosimilars, offering lower prices to pharmacy benefit managers and systematically stealing market share.
Hence the 36% drop.
Exactly. It reflects that harsh new reality.
But this is where the AbbVie story pivots from a tragedy into a masterclass in strategy. Because the legacy product is bleeding out, but the overall immunology portfolio is actually thriving.
It's remarkable.
They orchestrated this transition using a dynamic duo of newer immunology therapies, SkyRizzi and Renvoq. Both of these next-generation drugs grew by over 20% this quarter, completely absorbing the shock of Humira's decline.
The success of SkyRizzi and Renvoq forms the absolute core of the bull thesis for AbbVie. Management realized years ago that they couldn't just sit in their headquarters and wait for Humira to die.
They had to act.
Right. They actively funded research into more advanced, highly targeted therapies. SkyRizzi operates as an IL-23 inhibitor, and Renvoq functions as a JK inhibitor. They essentially chose to disrupt their own highly profitable monopoly before a competitor could do it to them.
Let's break down the science there so you, the listener, can really understand what those terms mean. What is an IL-23 inhibitor, and why is it better than the older technology?
Okay, so in autoimmune diseases like psoriasis or Crohn's disease, the patient's immune system is essentially sending out false alarms, right?
Right.
And this causes massive painful inflammation in the skin or the digestive tract. The immune system uses proteins called interleukins to send these signals.
Okay, interleukins.
IL-23 is one specific type of interleukin. Think of it as a highly specific alarm bell that triggers a very particular inflammatory pathway.
Got it.
Older biologics like Humira were somewhat of a blunt instrument. They broadly suppressed a wider range of immune responses.
So they hit everything.
Yeah, collateral damage. But SkyRizzi, as an IL-23 inhibitor, is incredibly precise. It puts a targeted muffler on that one specific alarm bell, halting the inflammation without suppressing the rest of the immune system as heavily.
So you get better efficacy with potentially fewer systemic side effects.
That precision is exactly what is driving the massive adoption. The commercial chief pointed out on the call that SkyRizzi is currently capturing a leading share of total new patient starts in the U.S., particularly for inflammatory bowel diseases like Crohn's and ulcerative colitis.
There was a major competitive threat looming over SkyRizzi recently, though. The market was bracing for an impact because a major new competitor drug, which the executives referred to as ICO, or Icotide, just launched for the treatment of psoriasis.
Yeah, that was a big concern.
Investors were genuinely worried this shiny new option would steal significant market share from SkyRizzi.
The competitive dynamic there is really fascinating. Icotide is an oral pill, whereas SkyRizzi is an injectable biologic.
Right, and usually when a new oral option hits the market, patients jump at the chance to avoid needles.
Naturally. But the AbbVie commercial team reported that they have seen absolutely zero degradation in their MBRX trends since Icotide launched in March.
Now, we should define MBRX. I see that acronym thrown around in pharma reports constantly.
It's a big one. MBRX stands for market-based prescription data. It essentially tracks new-to-brand prescriptions. It is the ultimate leading indicator for a drug's commercial health.
So it's basically counting the new customers.
Exactly. If your MBRX is growing, your total revenue will almost certainly grow in the following quarters as those new patients stay on the therapy. The executives noted that not only did SkyRizzi's MBRX not fall when Icotide launched, the growth rate actually accelerated.
Okay, wait. How does a major competitor launch their product and your sales go up?
It seems counterintuitive, right? But it happens when a market is vastly underpenetrated.
How so?
Well, there are millions of patients suffering from moderate to severe psoriasis who are simply using topical creams and haven't escalated to advanced systemic therapies yet. When a new competitor launches a massive marketing campaign for a new pill, it acts as a market-expanding event.
Ah, it drives disease awareness.
Exactly. More patients get frustrated with their symptoms, see the commercial, and finally make an appointment with their dermatologist. But when they get into the office, the physician evaluates the options and often chooses the drug they already know and trust.
The one with superior long-term data.
Bingo. In this case, that drug is SkyRizzi.
Yeah, the executives spent a lot of time highlighting SkyRizzi's clinical profile as a reason doctors stick with it. They pointed to the data showing high and durable skin clearance from head to toe.
Which is what patients care about most.
Right. They also mentioned superior efficacy in direct head-to-head clinical trials against 5 different mechanisms of action. Plus, there's the dosing schedule. You take a subcutaneous shot just once every 3 months, and your skin stays clear.
And if you contrast that quarterly shot with a daily oral pill that might offer lower overall efficacy, you start to understand the physician's rationale.
Yeah, taking a pill every day is annoying.
Adherence is a massive issue in medicine. Patients forget to take daily pills. But a doctor knows that if they administer a shot 4 times a year, the patient is fully medicated.
That makes total sense.
Furthermore, the management team highlighted that up to 30% of psoriasis patients eventually develop psoriatic arthritis, a really painful joint condition.
Ouch.
SkyRizzi now has 5 years of long-term clinical data proving it actively protects the joints from degrading. That level of comprehensive, proven data forms a massive clinical moat that a newly launched pill simply cannot match.
You are painting a very rosy picture of immunology here. You're telling me they are successfully replacing a $20 billion Humira monopoly with a drug that is performing even better.
That's what the data shows.
But aren't they just trading one massive dependency for another? I mean, why should an investor feel safe swapping the Humira cliff of 2023 for a future SkyRizzi cliff down the road?
That is the exact counter-argument to the bull case, and it is why we have to look at the rest of the portfolio.
Okay, let's look at it.
AbbVie is acutely aware of the danger of relying on a single pillar. That is why they have been quietly building a massive hidden powerhouse in their neuroscience division.
Oh, wow.
This segment was up 20% year over year, generating over $3.2 billion in revenue just in this quarter.
A $3.2 billion quarter means this neuroscience franchise is running at a $12 billion annualized rate.
Exactly.
It is basically a pharmaceutical giant hiding inside another pharmaceutical giant.
Right.
Let's break down where that specific cash flow is originating. Vraylar seems to be the anchor here.
It is.
It's their major psychiatry drug approved for bipolar disorder and as an adjunctive treatment for major depressive disorder. Vraylar brought in nearly $1.1 billion by itself, growing at 19%.
Yeah, Vraylar has cemented itself as a foundational treatment in modern psychiatry, but the broader strategic vision really comes into focus when you look at their migraine portfolio.
What are they doing there?
They have constructed a multi-layered defense against one of the most debilitating and common neurological conditions in the world. It starts with Botox therapeutic, which remains the absolute cornerstone for the prevention of chronic migraines.
Right, people know Botox.
But then they layered on Ubrelvy and Q-Lipta.
Now, Ubrelvy and Q-Lipta belong to a newer class of drugs called oral CGRP inhibitors. How do these actually function in the brain compared to older migraine medications?
So migraines aren't just bad headaches, they are complex neurological events.
Okay.
During a migraine attack, the nervous system releases a protein called calcitonin gene-related peptide, or CGRP.
Okay, CGRP.
This protein causes intense inflammation in the meninges, which are the protective membranes surrounding the brain, and it triggers severe pain signals.
That's awful.
It is. Now, older migraine drugs, like triptans, worked by constricting blood vessels.
Right, which isn't great.
It caused a host of cardiovascular side effects and didn't even work for everyone. But these new drugs are incredibly targeted. They specifically block the CGRP protein from binding to its receptors. Ah, so they cut the line.
Exactly. They essentially cut the communication line that transmits the migraine pain.
The strategy here seems to be covering every phase of the patient's disease. I mean, Ubrelvy is prescribed for acute treatment, right? When a patient feels the aura or the onset of a migraine, they take the pill to abort the attack.
Yep, that's the acute side.
But Q-Lipta, on the other hand, was initially approved for preventative use, taken daily to stop the migraines from forming in the first place.
They are completely blanketing the market. And during this quarter, they announced a major regulatory win. Q-Lipta is now approved in Europe for both acute treatment and once-daily preventative treatment for chronic or episodic migraines.
Oh, wow. That's huge.
Expanding the label geographically and functionally vastly increases the addressable patient population. The management team explicitly stated they project this oral CGRP portfolio will collectively achieve more than $5 billion in peak annual sales.
That is massive growth in migraine care. But they are also preparing to completely disrupt the Parkinson's disease market too, right? Yes. Parkinson's represents a critical area of unmet medical need. It is a devastating progressive neurological disease. It's characterized by the death of dopamine-producing neurons in the brain, leading to severe motor control issues.
It's a terrible disease.
The tragedy of Parkinson's is that the standard of care, a drug called levodopa, has not fundamentally changed in decades.
Really?
Decades, yeah. But AbbVie is attacking this disease with a multi-pronged approach. First, they have Vylev, which is a continuous infusion therapy designed for patients with advanced Parkinson's.
And how's that doing?
Vylev is already on track to be a blockbuster. It pulled in $256 million this quarter and grew 27% sequentially.
But the real star asset waiting in the wings is a drug called tavapadon. They are anticipating U.S. FDA approval and a full commercial launch in the third quarter of this year. The clinical data on this drug is generating immense buzz.
It really is, and to understand why tavapadon is so highly anticipated, you have to understand the nightmare of traditional Parkinson's treatment.
Walk us through it.
So, levodopa works by flooding the brain with synthetic dopamine to restore motor function. But over time, the brain's receptors become overly sensitized to the fluctuating levels of the drug.
Meaning it stops working smoothly.
Worse, it leads to severe, debilitating side effects called dyskinesia. These are involuntary, erratic movements that are often as distressing as the Parkinson's tremors themselves.
Wow, so how does tavapadon avoid causing that erratic movement?
Tavapadon is a novel, highly selective D1-D5 dopamine agonist.
Okay, jargon alert. What does that mean?
Instead of just dumping raw dopamine into the system like a flood, it acts like a precision key that only unlocks very specific dopamine receptors. The D1 and D5 receptors, which are deeply involved in smoothing out motor control.
So it's a sniper, not a shotgun.
Exactly. By selectively targeting these receptors, it provides the benefit of steady motor function without triggering the chaotic dyskinesia associated with broad-spectrum therapies. The long-term clinical data they presented is just remarkable.
What were the numbers?
After 85 weeks of continuous use, over 90% of the patients in the trial did not need to increase their dosage or add additional medications.
It essentially pauses the progression of the motor dysfunction. And crucially, it avoids many of the psychiatric side effects like extreme sedation and impulse control disorders that plague patients taking older dopamine agonists.
Right. It's a game changer.
Management did caution that they expect a relatively modest revenue ramp at launch because, it takes time to navigate the bureaucratic maze of getting a new drug onto Medicare formularies.
That's typical.
But eventually, they model their overall Parkinson's portfolio, pulling in over $5 billion in peak sales.
Think about the revenue stacking here.
Yeah, let's stack it up.
You have a projected $5 billion peak in migraine therapies, a projected $5 billion peak in Parkinson's, layered on top of the massive ongoing cash flow from Vraylar in psychiatry.
That is a serious engine.
That is the engine driving the 20% growth in neuroscience,
right.
And it perfectly answers your previous question about whether they are overly reliant on SkyRizzi. They are building multiple diversified pillars of revenue.
Well, we have spent a lot of time analyzing the massive successes in immunology and neuroscience. But, to maintain objectivity in this deep dive, we have to look at the segments that are currently bleeding.
Fair enough.
Both the oncology and aesthetics divisions were down slightly this quarter. Let's start with oncology. Total revenues came in at $1.6 billion, which represents a 2.4% dip year over year. What is driving that contraction?
The primary culprit pulling down the oncology numbers is Imbruvica.
Imbruvica. For
years, Imbruvica was a foundational treatment for various forms of blood cancer and a massive revenue generator for AbbVie. But sales plunged 29.4% this quarter alone.
It is a steep drop.
It is a brutal deceleration, and it is being driven by a combination of intense new competitive pressure from rival drugs in the same class and, more significantly, the IRA.
Right, the Inflation Reduction Act. This is the recent federal legislation that fundamentally changed the pharmaceutical landscape by allowing Medicare to negotiate drug prices directly with manufacturers for the first time.
Yes, a massive policy shift.
And Imbruvica was one of the very first drugs selected by the government for these mandatory price negotiations.
Exactly. The legislative impact is actively degrading the revenue base for that specific asset. The pricing pressure is real and it is permanent.
So what's their move?
Well, AbbVie's management team clearly anticipated this regulatory shift. They are pivoting their entire oncology strategy away from older small molecules and aggressively toward a newer, highly complex mechanism of action known as ADCs, or antibody-drug conjugates.
We really need to unpack the science behind ADCs because the executives spent a significant amount of time highlighting three specific ADC assets: Elahere, Epkin-Le, and their newly launched DECNPAS.
How does an ADC fundamentally change the way we treat cancer?
The easiest way to visualize the evolution of cancer treatment is to compare traditional chemotherapy to an ADC.
Okay, let's compare them. Traditional systemic chemotherapy is effectively a biological carpet bomb.
Just destroy everything.
Right. You infuse highly toxic chemicals into the patient's bloodstream, and those chemicals kill any cell that is rapidly dividing. It kills the cancer cells, sure, but it also annihilates healthy cells. Hair follicles, stomach lining, immune cells.
Which causes the brutal side effects we all know about.
Exactly. An ADC, on the other hand, is a guided missile.
A guided missile.
It consists of three parts. First, you have a monoclonal antibody, which is a protein engineered in the lab to seek out and bind only to a very specific biomarker found on the surface of a cancer cell.
So that's the targeting system.
Precisely. Attached to that targeting antibody by a chemical linker is a highly toxic chemotherapy payload.
Oh, wow. So the antibody circulates harmlessly through the bloodstream, ignores the healthy cells, finds the specific cancer cell, attaches to the exterior, gets absorbed inside the cell walls, and then the chemical linker breaks, releasing the toxic payload directly into the tumor.
You've got it. It maximizes the destruction of the malignant tumor while minimizing the collateral systemic damage to the rest of the patient's body.
That's incredible technology.
It is, and the clinical applications are expanding rapidly. They just received FDA approval for DECNPAS, which targets an ultra-rare, aggressively fatal blood cancer called BPDCN.
Okay, what else?
They also have Elahere, which is showing strong results in ovarian cancer. But the asset generating the most long-term excitement is an ADC currently known as TMA-A, which is moving into late-stage trials for lung, colorectal, and ovarian cancer.
Yeah, the data they shared on TMA-A was staggering. The drug targets a specific protein called c-Met. They noted that in trials for advanced head and neck cancer, patients who tested positive for this specific biomarker experienced a median overall survival of 15.3 months.
That's a big deal.
They stated that this survival rate compares extremely favorably to the current standard of care for these devastating diagnoses. So, while the government pricing pressures are shrinking the legacy Imbruvica revenue, AbbVie is actively building an entirely new foundation in precision oncology to replace it over the next 5 years.
It is the exact same playbook they successfully executed with Humira. Anticipate the inevitable decline of a legacy product, aggressively fund the research to build the superior replacements, and flawlessly execute the commercial transition.
It's a proven formula for them. Let's transition over to the other segment facing headwinds. Aesthetics.
Right.
Global sales came in at nearly $1.3 billion, which is down 0.9%. The interesting dynamic here is the massive divergence in performance between their core products.
It's a very telling split.
Yeah, Botox Cosmetic was actually up 3.4%, bringing in $728 million, while their dermal fillers, specifically the Juvederm portfolio, dropped 6.6% down to $245 million. We are moving away from government-funded healthcare and entirely into the realm of out-of-pocket consumer discretionary spending.
A completely different beast.
What are the macroeconomic forces at play here?
The divergence between Botox and Juvederm is a perfect real-time indicator of middle-class consumer sentiment.
Really? How so?
When inflation remains sticky, the cost of living increases, and interest rates stay elevated, the middle-income consumer immediately starts pulling back on big-ticket discretionary items.
Right.
And the financial commitment required for these two procedures is very different. A dermal filler procedure using Juvederm typically involves a higher upfront cost and represents a longer-lasting, more significant cosmetic change.
So people are feeling the pinch at the grocery store, and they decide to delay the $1,000 filler treatment.
Exactly.
But they are still willing to drop a few $100 every few months to freeze their forehead wrinkles with Botox. It sounds exactly like the classic lipstick effect, where consumers facing economic stress will cut out luxury vacations or expensive cars, but they will still purchase small, affordable luxury items to treat themselves and maintain their baseline routines.
That captures the dynamic perfectly. The management team specifically cited macroeconomic headwinds in key global dermal filler markets as the primary drag on growth.
Makes sense.
The crucial takeaway for investors, however, is that the underlying consumer demand has not vanished. It is simply being deferred.
They still want it.
The desire for aesthetic treatments hasn't gone away at all. As the broader economic environment eventually stabilizes and discretionary income frees up, the dermal filler market is highly expected to rebound, primarily because aesthetic treatments remain severely underpenetrated globally outside of major coastal urban centers.
So, buying this all together, the current growth engines, SkyRizzi, Renvoq, and the rapidly expanding neuroscience portfolio, they're firing with enough force to completely offset the temporary laggards in oncology and aesthetics.
Oh, absolutely.
This leads us directly into the management guidance section of our breakdown. What is the executive team telling Wall Street to expect for the remainder of 2026?
The guidance section of this earnings call was incredibly bullish. AbbVie actively raised its full-year revenue forecast to $67.6 billion.
Wow.
And it is important to contextualize this. They raised guidance by $300 million today, which stacks on top of a previous $300 million raise earlier in the year.
So that's a $600 million total upward revision.
Exactly, since their initial forecast.
And the undisputed crown jewel of that forecast is SkyRizzi, which is now expected to bring in $21.7 billion this year all by itself. I want you to really internalize the scale of that number. $21.7 billion.
Unbelievable.
Generated by a single drug in a single 12-month period. That figure completely erases the historical anxiety surrounding the loss of Humira.
It absolutely does. And looking at the bottom line profitability, the management team guided for full-year adjusted EPS to land between $13.87 and $14.07.
Okay, wait.
But this is exactly where a retail investor needs to carefully translate the accounting jargon to understand the true health of the business.
I am glad you brought that up, because if an analyst simply glances at that $13, $87, and $14.07 range, they might be confused. We just spent 20 minutes discussing how AbbVie crushed their revenue estimates and demonstrated massive operational efficiency. Why isn't the EPS guidance rocketing upward to match that narrative?
Well, if you strip out the strategic acquisitions, the EPS guidance actually is rocketing upward.
Okay, explain.
The management team explained that the updated guidance range includes a 10-cent organic operational improvement driven entirely by the massive sales momentum of their core products.
That's the core health.
Right. However, that impressive operational outperformance is being intentionally masked by a 14-cent expected dilution stemming from a planned corporate acquisition.
Let's examine that acquisition. They announced they are buying a clinical stage biotechnology company called Apogee Therapeutics, with a deal expected to close in the third quarter.
Yeah, that's the one.
I have to play devil's advocate here. Are they just buying an external company to artificially inflate their future revenue and keep the Wall Street momentum going? We see mature pharma companies do this all the time when their internal research and development labs dry up and fail to produce new blockbuster candidates.
It is a fair question, but looking at Apogee's portfolio, this is a highly strategic offensive maneuver designed to widen their economic moat.
How so?
Apogee is a clinical stage company. They are not generating massive commercial revenue today that AbbVie can simply absorb to pad their quarterly numbers.
Okay, so it's not a revenue grab.
No. What Apogee possesses is a pipeline of highly differentiated, long-acting biologics, specifically targeting dermatology, respiratory conditions, and other complex inflammatory diseases.
So they are acquiring novel scientific assets to reinforce an immunology pipeline that is already the strongest in the world.
Exactly. The strategy here demonstrates incredible foresight. AbbVie completely dominates the global immunology market today with SkyRizzi and Renvoq. But pharmaceutical companies live and die by the patent calendar.
All right, the clock is always ticking.
They know that eventually the protective patents on those drugs will expire. SkyRizzi's regulatory data protection begins to erode in 2031, although they have built a dense thicket of secondary patents that they expect will defend its market exclusivity well into the mid-2030s.
So they have some time.
They do, but by acquiring Apogee today, they are effectively purchasing the next generation of immunology therapies. They are actively securing their market dominance for the 2030s and beyond, long before their current stars face biosimilar competition.
It is a very aggressive posture. They are signaling to the market that they refuse to rest on their current laurels. They are taking the massive cash flow generated by today's commercial hits and immediately reinvesting it to purchase the fundamental science that will become tomorrow's blockbusters.
Exactly.
Even if that acquisition causes a 14-cent dilution on a spreadsheet for the current fiscal year.
And this relentless focus on future growth ties perfectly into the internal R&D pipeline updates we haven't even touched on yet. They are not merely buying innovation from the outside. Their internal laboratories are rapidly advancing some truly groundbreaking science.
Let's explore some of that internal science, because the clinical trial data they discussed borders on science fiction.
It really does.
We already covered the precision oncology ADCs, but let's pivot back to immunology for a moment. They highlighted a pending regulatory catalyst, a sub-Q induction for SkyRizzi in Crohn's disease that is currently under FDA review, with a decision expected this fall.
This is a huge deal.
For the layperson, why does the method of delivery matter so much commercially?
The method of delivery is a massive commercial catalyst because it directly impacts both patient quality of life and clinical logistics.
How so?
Currently, when a patient suffering from severe Crohn's disease begins treatment with SkyRizzi, they must undergo an induction phase to quickly build up the drug levels in their system. This requires the patient to physically travel to a specialized clinic and sit for an intravenous infusion, an IV drip, for their first few loading doses.
That sounds incredibly inconvenient.
It is cumbersome, it requires taking time off work, and it involves complex, expensive medical billing procedures for the clinic.
So the sub-Q version, the subcutaneous injection, would completely eliminate that friction.
Precisely. If approved, the induction dose could be administered via a simple shot under the skin. It removes a massive logistical hurdle for both the patient and the prescribing physician.
It just makes it easier to adopt.
But the commercial advantage isn't just about convenience. The clinical data supporting the sub-Q induction was absolutely staggering.
What were the numbers?
Management reported that the subcutaneous version achieved clinical remission rates that were 25 percentage points higher than the placebo group.
Wow.
And a remarkable 45 points higher in patients who are completely naive to advanced biologic therapies.
Yeah, I read the transcript of the chief scientific officer's comments.
Yeah.
He stated outright, "To our knowledge, these results are the highest reported for induction therapies in Crohn's disease."
It's unprecedented.
They are not just creating a more convenient version of their drug, they are clinically outperforming their own existing IV version, as well as every other approved competitor agent on the market.
Exactly.
The commercial chief emphasized that this combination of massive clinical efficacy, ease of use, and simplified billing will drive a highly meaningful acceleration of overall sales in the gastrointestinal space.
And that is merely the first step in their GI strategy. They are already actively testing combination therapies.
Combination?
Yeah, they are running advanced clinical trials where they combine SkyRizzi with novel experimental pipeline agents, such as an anti-alpha-4 beta-7 antibody.
Okay.
The interim data from these trials demonstrated a doubling of endoscopic remission rates compared to using either drug in isolation.
A doubling?
Yes. The ultimate goal is no longer just managing the symptoms of Crohn's disease. They are aggressively pursuing functional cures.
That is just incredible for patients. If we shift our focus back to neuroscience, we cannot ignore the updates on their Alzheimer's disease research.
This is the holy grail.
This is notoriously the most difficult field in modern medicine, basically a graveyard for pharmaceutical capital.
Yeah.
But they highlighted an early-stage asset currently named AbbVie 1758, which utilizes something called blood-brain barrier shuttle technology.
Yes, shuttle technology.
Break down the biology of this for us. The brain has an intense natural security system, correct?
It does. The blood-brain barrier is a highly selective, semi-permeable border of tightly packed endothelial cells that separates the circulating blood from the brain and extracellular fluid in the central nervous system.
So that keeps the bad stuff out.
Evolutionarily, it is a brilliant defense mechanism designed to prevent blood-borne pathogens, toxins, and infections from entering the brain. However, for drug developers, the blood-brain barrier is an absolute nightmare. It aggressively blocks the vast majority of therapeutic molecules from ever reaching the diseased tissue.
How much actually gets through?
A standard naked therapeutic antibody might only achieve a 0.1 or 0.2% penetration rate into the brain.
So you have to pump the patient full of massive potentially toxic doses of a drug just to force a minuscule therapeutic fraction of it across the barrier to the actual site of the disease.
That is the central challenge in treating neurodegenerative diseases like Alzheimer's. But AbbVie has developed a proprietary shuttle technology that effectively tricks the barrier into pulling the therapeutic payload across.
Freaking it. I love that.
This new tech is achieving over 1% penetration.
Now, 1% might sound small in absolute terms to our listeners.
But it represents a several-fold exponential increase over traditional methods.
If they can consistently achieve that level of penetration, how does it alter the actual patient experience of treating Alzheimer's?
It changes the entire treatment paradigm. Currently, Alzheimer's therapies often require frequent, massive, and incredibly expensive 5e infusions in a clinical setting.
Right, which is awful for an elderly patient.
Exactly. If you can get significantly more of the drug into the brain using the shuttle technology, and you design the drug to have an extended half-life, you might be able to treat Alzheimer's patients with a simple once-a-month subcutaneous injection.
That would be revolutionary.
Furthermore, they are exploring the use of this exact same shuttle technology to deliver Cernena, which are gene silencing therapies designed to target and halt the production of toxic tau proteins, which are a hallmark of Alzheimer's pathology.
We are talking about literal sci-fi medicine at this point, and they are applying similarly disruptive thinking in the field of psychiatry with an asset called emraclidine, which is being developed for schizophrenia.
Yes, emraclidine.
Historically, antipsychotics rely on blocking D2 dopamine receptors, which can cause severe side effects like extreme weight gain, metabolic syndrome, and tremors.
Horrible side effects.
Emraclidine is a once-a-day pill that targets a completely different pathway, the muscarinic receptors, aiming to control the psychosis while entirely avoiding those debilitating gastrointestinal and metabolic side effects.
That's the promise.
And the phase 2 dose-finding trials are currently demonstrating a highly safe and tolerable clinical profile, and they are rapidly advancing the drug into larger late-stage efficacy studies.
When you aggregate all of these separate data points, the strategic Apogee acquisition, the impending launch of the SkyRizzi sub-Q induction, the revolutionary Alzheimer's shuttle technology, the Parkinson's launch, and the precision oncology ADCs, the financial picture becomes incredibly clear.
It really does.
You suddenly realize that the 17-cent hit for acquired IPR&D and the 14-cent expected dilution for Apogee are not penalties at all.
No.
They are arguably the cheapest, most efficient investments management could possibly make to secure the long-term future of the entire enterprise.
Well, we have thoroughly unpacked the financial data, we have analyzed the complex story behind the portfolio transition, and we have explored the massive potential of the R&D pipeline. Now, it is time to distill all of this into the bottom line.
Let's do it.
Our listeners, tune into this deep dive for actionable intelligence. So I'm putting you on the spot for a definitive stance based on the sources we've reviewed. What does this specific earnings call mean for the retail investor who is either currently holding or perhaps actively researching the ABBV ticker today?
Based on the operational metrics and the pipeline development presented in this quarter, it is a firmly bullish signal.
Firmly bullish.
The level of execution demonstrated here is extraordinary.
Elaborate on that. Address the lingering skepticism in the market. Why should an investor feel confident buying in near all-time highs when the company just lost its biggest historical revenue driver?
Well, for the better part of the last 5 years, the bear thesis on AbbVie was entirely built on the fear of the unknown.
Right. The Humira cliff.
The narrative was constantly, they are far too dependent on Humira. When the patent cliff finally arrives, top-line revenues will inevitably crash, the massive dividend will have to be slashed to conserve cash, and the stock price will crater.
That was the consensus.
This Q2 earnings call serves as the final, definitive data point dismantling that narrative entirely.
Because Humira's global sales plummeted by 36% this quarter, and yet the company as a whole still managed to grow its top-line revenue by over 10%.
Exactly.
The widely feared cliff wasn't actually a cliff at all. It functioned more like a trampoline.
That is the ultimate takeaway. If you currently hold the stock, this quarter provides extreme validation of the executive management team's strategic vision and operational execution.
This validation.
They successfully navigated what was arguably the largest, most publicized, and most feared patent cliff in pharmaceutical history, and they did it almost seamlessly. They fiercely protected their dividend, they accelerated top-line growth, and they maintained massive, industry-leading operating margins throughout the entire turbulent transition.
And for the investor who is considering initiating a position today, what exactly is the underlying asset they are buying into?
You are buying into a premier, highly diversified global healthcare powerhouse. You are buying the undisputed dominant player in the immunology space, anchored by SkyRizzi and Renvoq, both of which possess years of robust patent protection and massive remaining growth runways.
Okay, that's immunology.
Right. You are also buying a stealthy, rapidly expanding neuroscience franchise that is already generating $12 billion annually and launching novel therapies for migraines and Parkinson's.
A hidden gem.
And perhaps most importantly, you are buying a highly aggressive, well-funded R&D pipeline that is actively pioneering revolutionary blood-brain barrier shuttles and next-generation precision cancer ADCs.
So they aren't just treading water.
Not at all. They aren't merely patching the revenue hole left by Humira. They are actively constructing the architectural foundation for the entire next decade of growth.
It truly is an incredible story of corporate resilience, scientific foresight, and ruthless execution. Thank you for walking us through that complex clinical and financial data. I believe our listeners now have a crystal clear understanding of exactly why the headline numbers look so strong, and more importantly, what those underlying metrics signal for the company's long-term trajectory.
It will likely be studied in business schools as a textbook case of how to masterfully manage the life cycle of intellectual property.
Now, before we completely wrap up this deep dive, I promised you, the listener, one final piece of homework. A fascinating little nugget hidden deep in the transcript to chew on. We barely touched on the aesthetics pipeline during our macro discussion, but buried in the R&D updates was an update on a novel product they referred to as Bowie.
The development of Bowie is a fascinating study in consumer psychology and market expansion.
What is it exactly?
Yes. Bowie is an entirely new formulation of neurotoxin designed for rapid onset and, crucially, a very short duration of effect. They recently secured regulatory approval for this specific product in both Europe and Canada.
So Wall Street analysts are entirely obsessed with modeling out the billions of dollars flowing from immunology and neuroscience. But I want you to pause and ponder what happens to consumer behavior when Bowie eventually hits the massive U.S. aesthetics market. Think about this product concept as weekend Botox.
Weekend Botox.
Yeah.
The strategic psychology behind creating a short-acting toxin is brilliant.
Why is that?
If you study the aesthetics market, the single biggest barrier to entry preventing new patients from seeking injectable treatments is fear.
Fear of what? Looking weird.
Exactly. Consumers, particularly younger demographics who have never had a cosmetic procedure, are absolutely terrified of getting a bad result. A frozen forehead or an unnatural look that they are physically stuck with for 4 to 6 long months while a traditional toxin slowly wears off.
Enter Bowie. The clinical profile changes the entire risk calculation for the consumer. It kicks in rapidly, providing the desired aesthetic smoothing, but it also wears off relatively fast.
That's the key.
It represents a temporary, almost completely commitment-free cosmetic option. Imagine a consumer who wants to look exceptionally sharp for a specific time-bound event, like a wedding, a high school reunion, or a major presentation. But they have zero desire to freeze their facial expressions for half the year.
Boom.
Weekend Botox solves that exact consumer pain point.
In marketing terms, it is a classic market-expanding innovation. It lowers the psychological barrier to entry, allowing hesitant, risk-averse consumers to safely preview the benefits of aesthetic injectables.
Try it before you buy, basically.
Pretty much. Once they experience the procedure, realize it is medically safe, and see that they actually enjoy the cosmetic results, the probability that they eventually graduate to purchasing the longer-lasting, more expensive traditional Botox products increases exponentially.
So, will this temporary toxin completely blow open an entirely new demographic of younger, commitment-phobic consumers? I highly suggest you keep a close eye on the aesthetics market going forward. Because while the segment might be down slightly today due to temporary macroeconomic pressures, a revolutionary low-commitment product like Bowie might be about to fundamentally change consumer behavior and dramatically expand the total addressable market.
It creates a perfect cyclical tie back to the central theme we established at the very beginning of this discussion.
It really does. We opened by asking how a massive organization survives the inevitable loss of a star employee, the expiration of the magical contract that built the company.
The data proves you don't survive by clinging desperately to the past or attempting to squeeze the last few drops of revenue from an aging asset.
No.
You survive by aggressively disrupting your own business model before the broader market has a chance to do it for you.
That's the lesson.
Whether it is deliberately cannibalizing Humira with the superior science of SkyRizzi, completely shifting your oncology strategy from traditional small molecules to precision-guided ADCs, or engineering a short-acting toxin to hook an entirely new generation of aesthetic consumers, AbbVie is demonstrating that true corporate longevity isn't about fiercely protecting one golden goose.
Exactly.
It is about understanding the fundamental science of how to breed the next flock.
And on that provocative note, we will leave you to ponder the future of your own portfolio and how the companies you hold are preparing for their own inevitable transitions. Thank you for taking this deep dive with us today.